Brent crude is at 95.36. I'm going to say that again, 95.36. Most traders are staring at the 3-day win streak that just snapped, seeing red, and thinking the bottom is about to fall out. That is exactly the trap. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade tomorrow, including a sniper entry that most of the market will chase too late. This is not a drill. The war premium is exhaling, and 93.96 is the collapse line. If you want to know why everybody is about to get it wrong, keep watching Instant Market Verdict. Session bias, fading into a range with a bearish lean, but the lower band of that range is the real story. The intraday sell signal we are seeing on the 5-hour and 1-hour charts is real, but the daily trend is strong sell while the weekly is neutral and the monthly still screams strong buy. That is a classic compression setup. We are coiling, not cratering, unless one number breaks. Write this number down, 93.96. If we close below 93.96 on the daily chart, the entire structure resets to a distribution regime, and the herd that's still holding hope of a V-shaped recovery gets liquidated. Right now, the herd is long from the 95.50 breakout last week, and stops a building just under 95.20. That's the fuel. That's where the engine of the next move comes from. Now, let's walk through the technicals from the top down, because this is where most traders miss the hidden divergence. On the weekly chart, price is hovering just above the 200-week moving average, which sits right around 95.68. That line has been a brick wall for 3 consecutive candles, and we are now testing it from below after losing that level intraday. The monthly chart is still in a strong buy structure, meaning the pullback we are in has not yet broken the macro bull trend, but the weekly neutrality tells you the tide is undecided. Move down to the daily, and the picture gets darker. The daily trend is a strong sell, with price trapped below the MA50 at 95.86 and the MA100 at 95.94. The 20-day moving average at 95.32 has been knifed through today. This is a bearish alignment. The shorter MAs are crossing below the longer ones, and the 200-day moving average at 95.68 is now acting as overhead resistance. Here's what most traders miss. Open your 4-hour chart. Look at the MACD. We have a negative print of minus 0.26, and it's been building lower lows while price made a minor bounce. That is hidden bearish divergence. Buyers are exhausted, and the bounce was pure ceasefire headline noise, not genuine demand. The RSI on the daily is at 48.6, dead mid-range, giving no oversold lifeline yet. And the stochastic is at 84.4, overbought on the intraday timeframe. That combination is dangerous for anyone trying to catch a falling knife. Immediate support is 95.20, a level that already got kissed today. Below that, the next major demand zone is 93.96, which aligns with a prior monthly breakout point. Resistance is stacked right where the moving averages sit. 96.51 is the first ceiling, followed by the cluster at 99.06 to 100.30. For now, every rally into that 95.80 to 96.50 zone is a short opportunity until proven otherwise. The cross-asset linkage confirms this. Brent is moving tick for tick with the deflating geopolitical bid. When the ceasefire headlines hit, war premium exhaled, and it dragged crude down in lockstep with falling natural gas and easing shipping insurance costs. That correlation is not breaking yet. Let's connect the fundamental driver directly to price action now, because yesterday's ceasefire between Israel and Lebanon changed everything in the short term. The oil market had priced a 3-day win streak on the back of escalating rhetoric, but the moment that de-escalation became tangible, the air came out. This is what the analyst notes call war premium exhaling, no breaking. It means we are not seeing a structural supply shock. No wells have been hit, no strait has been closed, so this pullback is simply the removal of fear. However, and this is critical, the market is now quietly shifting attention to demand. The forward curve is flattening. Refinery margins are softening. The next 2 weeks will be governed by whether physical demand data confirms the slowdown that the paper market is already pricing. My directional lean for the next 1 to 2 weeks is a grind down towards that 93.96 demand zone, followed by a violent repricing if that level holds. The exact event that invalidates this bearish drift is a sudden supply disruption, or a close above 100.30 on the daily chart. Do you think Brent holds 93.96 this week? Comment hold or break right now. I'm tracking consensus and I'll call out the majority bias in tomorrow's video. Now we arrive at the trade setups. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm going to give you 3 exact playbooks, with entry triggers, stops, and reward ratios you can screenshot. Starting with the sniper. Strategy 1. The sniper, conservative. The idea here is not to predict the collapse, but to wait for the market to prove that 93.96 is a genuine floor and then ride the reversion back into the value zone. The trigger condition is simple. We need a 1-hour candle close above 94.40 and simultaneous bullish MACD cross on the 1-hour chart. That confirms that the stop run below 95.20 has been absorbed and the demand zone is active. The entry is at 94.45 with a limit order. The stop loss goes at 93.70, just below the 93.96 demand zone, giving a tight 75 tick risk. The logic is that if 93.96 fails, the structure has broken and we do not want to belong. Take profit 1 sits at 95.85, right at the MA50 resistance cluster. That gives a first reward of about 140 ticks, a risk reward of 1 to 1.8. Take profit 2 is at 97.40. Below the next resistance zone, extending the reward to nearly 1 to 3.5. The setup is void if Brent prints a daily close below 93.96 before the entry triggers the sniper, conservative, entry. 94.45, 1H close above 94.40 plus bullish MACD cross, stop loss. 93.70 take profit 1, 95.85 take profit 2, 97 to 40 risk, reward. 1:3.4 are invalidation. Void if daily close below 93.96 strategy 2, the active trader. This one plays the mean reversion inside the range, exploiting the fact that price keeps getting rejected at the moving average cluster. We sell into strength. The trigger condition is a pullback to the 95.80 level, which must coincide with a bearish rejection candle on the 15-minute chart, a pin bar or engulfing candle. Entry is at 95.80. Stop loss is placed at 96.55, above the 96.51 resistance and the MA200. That's a 75 tick risk, mirroring the sniper's tight structure. Take profit 1 is 94.90, just above the 95.20 support but before the real demand zone, capturing the liquidity run. That gives a 90 tick profit, a 1 to 1.2 ratio. Take profit 2 is 94.20, right above the demand zone, for a 160 tick gain, 1 to 2.1 ratio. The trailing stop rule. Once TP1 is hit, move your stop to break even and trail by 30 ticks. This setup is ideal for range days with no headline shock. Type your Brent oil range for tomorrow in the comments now. Let's see who's aligned with the active trader play. The active trader, standard, entry. 95.80, 15-minute bearish rejection. Candle, stop loss, 96.55 take profit 1, 94.90 take profit 2, 94.20 risk, reward. 1:2.1 trailing rule, move SL to BE after TP1, trail by 30 tick strategy 3, the aggressor. This is a high risk, momentum chase short for those who can lose small and manage risk aggressively. The premise is that the 95.20 level will break intraday with momentum, triggering the stops we talked about. The trigger is a 5-minute close below 95.10 with volume spike. Entry is at 95.08 market order. The stop loss is extremely tight at 95.55, just above the prior 1-hour consolidation high. That's a 47 tick risk. Take profit 1 is 94.30. a 78-tick move for a 1 to 1.6 ratio. Take profit 2 is 93.55, inside the demand zone, stretching to 153 ticks, a 1 to 3.2 ratio. This setup is only for those who accept that a sudden ceasefire headline upgrade or an OPEC whisper could reverse the trade instantly. No excuses. Tight stop, no hesitation. The Aggressor, high risk, entry, 95.08, 5-minute close below 95.10 plus volume spike, stop loss, 95.55 take profit 1, 94.30 take profit 2, 93.55 risk, reward, 1:3.2 hour warning, voids instantly on any hourly close above 96.00 risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like EIA inventory or unexpected OPEC commentary. Stops are non-negotiable. This is how you survive to trade the next big move, and the next one after that. Now let's close this out and look ahead. The single most critical level for tomorrow's session is 93.96. If that level holds, we are in a tactical bottoming zone and the sniper play triggers. If it breaks with volume, the liquidation cascade goes live, and the aggressor's targets become the next support floor. Tomorrow's wildcard is the API inventory report. If it prints a surprise build, the demand fear narrative accelerates, and we'll be testing 93.96 sooner than most expect. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.